cash flow is king. Cash flow is everything. And even businesses that are growing rapidly, successfully, and profitable can go out of business. Why? Because just because you're generating revenue doesn't mean you're getting paid.
Hello and welcome to the Tracer Franchising Podcast, where we interview great franchisors, franchisees, and the people who support them. Today, we have Daryl McLinden from TMG Consulting that does some interesting work. A lot of it is finance related. I know there's some HR stuff, fractional CFO. We'll let him explain it. But this is a interesting episode for anyone who wants to own a business. I think the numbers are supremely important, and they're things that people glaze over, I think, a little too easily, as well as lending is super important. And then for those who own a business, again, if you don't run your books properly, you could easily let you think you're making money and you're not. So this is going to be a great conversation. Daryl, thanks for being here.
Great. Thanks, Josh. I appreciate you. Appreciate the invite and looking forward to it.
Yeah, for sure. So let's just start with, can you give us kind of the short version of your background and what TMG Consulting does for business owners?
Absolutely. So my background is as a CPA, but I've had this business now for over 35 years. Before fractional was a thing, and now there's a lot of firms that are doing it, but we have been in the business probably the longest out of anybody, frankly, in the country. So a lot of experience in this space. We have 52 consultants, everything from CFOs, controllers, staff accountants, and bookkeepers. And really what we do, we're not a CPA firm. We're not doing audit and tax work. We are helping business owners and small businesses make sure that their accounting is cleaned up and accurate, and their financial statements are clean and accurate on a timely basis. Because one of the biggest things, it's so important to make sure that every business is tracking dollars, tracking revenue, tracking expenses and cash, and understanding what's working and what's not on a timely basis so they can make changes and improve the business along the way.
Got it. And so do you also help them understand? Because I've seen people kind of get these statements and they just don't even know what to do with it, especially when they're starting new, like most franchise owners are. Do you do that as well?
Absolutely. One of the big parts that you'll see it on our website too, if you go out to tmgconsulting.biz, the website, there's testimonials out there. And we also talk about our approach. And our approach is really hand-holding the owner and his or her team to really help them understand what these financial statements mean and why are they important, especially for non-financial people. So once we get the financials cleaned up and we have good, solid information on the accounting and the reporting, we then share and mentor them up so they begin to understand the importance and the value of these reports and why they're so important to run the business. Every company in the world runs financial statements to manage a business, no matter what their size. Startup or multi-billion-dollar businesses all have accounting systems and financials. Why? To manage the business and report on what's working and what's not. So that's very important, and we want to make sure all of our clients learn from the information we have and they become more educated on how to use this information.
Yeah, and I think you said, you help them clean up the books, know their numbers. What are problems that you're usually finding when people hire the firm?
A lot of times they are trying to save dollars. They don't want to spend money on accounting or bookkeeping, and they just basically work off their checkbook. They're not always looking and reconciling their bank accounts, reconciling credit cards. They're not really understanding their revenue cycle or their purchasing cycle. So they're not really following what's coming in and what's going out. And that's really the lifeblood and the heartbeat of the business is what's coming in, what's going out, making sure it's accurate. And that involves making sure that you're on a timely basis every month, reconciling bank statements, reconciling credit cards, all the expenses, all the revenues, all the expenses to make sure you know what's coming in and what's going out and what that means for the business. And a lot of times people wait 3, 6 months, 9 months. We've had clients where they haven't reconciled things for 3 or 4 years. Well, they really have no idea what's going on. And then sometimes it's too late. So it's more important to be timely and accurate, get up to speed, get on it right away. Don't wait until it's too late.
Okay. Yeah. So you're just, like you said, helping know what's coming in and what's going out so they can have a firm grasp of the business. But that, helps them know their numbers, like in practical terms, right? The guys who are going out, some of these guys running $1 million, $2 million landscaping businesses, right? Like you said, they're going off their checkbook. Hey, there's more in it today than there was tomorrow. My guys are filling up their trucks. I'm invoicing people. Like what does it mean to know their numbers and what benefits are they getting out of that?
Well, the biggest example is you mentioned if they're filling up their truck. Well, do they know how much gas is consumed in a month to manage their jobs? Do they understand what costs that has on each job? Are they allocating those costs to each job? So they make sure they're capturing in their revenue enough dollars to compensate them for that, plus any profit needed. So they've got labor, they've got truck expense, they've got materials. Do they really understand what the costs are that go into completing that job? And are they charging enough to generate enough margin so they make money on every job? And that's a big deal because a lot of times, oops, we made a mistake. We forgot to estimate that there's an extra skid load of dirt that needs to go here. And that's an extra $500, but we didn't factor that in. Well, now that's $500 less than your profit for that one job. Well, how many jobs are like that? Do we have issues like that across many, many jobs? So it's important to get on top of that right away so you understand true profitability for every job or whatever is your item that you're selling or generating revenue for. You need to understand those facts and what's working and what's not.
Yeah, I think especially the per job is so huge that a lot of business owners I've spoken with were like, "Oh yeah, I cut 4 clients because I was losing money on all of them. I didn't realize it because I was just looking at labor, and we were making more than the labor, but there's so many other things that go into it."
Correct. For example, if you have labor and you have payroll taxes, you may have benefits, a 401k match. You may have other things that are attached to that, and those costs are on top of what you pay your employees. So, has the owner factored those into their costs to say, well, yeah, I'm paying $10 an hour, but I've got $5 an hour of overhead, of benefits, payroll taxes, and things that you're going to have to pay as an employer. Are they included in your estimate of what the costs are to run that job? And those are the things a lot of times get missed. So it's important to make sure you've got people that understand that and you can truly understand what's working and what's not.
Awesome, and I'm sure we just kind of touched the tip of the iceberg here on numbers. But a lot of the people listening are going to be preparing for a franchise, right? To own a franchise. So for someone buying their first business, um, what are they kind of we should be thinking about beforehand, right? What are the most important things to think about before they even purchase the franchise?
Well, the biggest thing is you have to understand what's the scope of this investment. What's it going to take to purchase and acquire a franchise? And what is the cost going to be to start it up and get going with it? Because that's going to require significant capital. And you need to understand how much that's going to be, both to physically actually buy and purchase the franchise, but what are the costs to initiate it and get started with it? You could have 30, 60, 90 days of costs you're incurring before you ever generate first one in dollars for the revenue of the business. And then maybe another 30, 60 days to actually collect on your billings on your receivables. So you need to understand the cash flow requirements for the initial purchase and what's the cash flow requirements for the first 30, 60, 90 days of operations, assuming you have no revenue coming in. So you have to look at that and that you look at the scope of the franchise. And normally the franchisor will, excuse me, will provide you with the information so you understand what the initial cost will be, how much of that you have to provide in your own capital, how much can you get financing for, and then from there, how much cash will you need either through capital or bank financing to get you through the first point where you start to generate revenue. You need to get to the point where it's cash flow positive, and that may usually takes a lot longer than you expect. So you have to really do that. Well, in order to do that, you have to build out financial models. And that includes the 3 basic statements. That's the balance sheet, income statement, and cash flow, and then projections. And what the projections do are going to show you what the anticipated revenue, anticipated cash flow is going to be for the business for the first 1 to 5 years. You need to build that model out to really show what's going to happen with this business over the first 6 months, year, 2, 3, 4, 5. As you do that, that'll help calculate what the capital requirements are or the potential bank financing is required to put this deal together. And you're going to need all that for both the franchisor and the banks to look at and evaluate this franchise to see if it makes sense for you and is a viable option.
Yeah. And you hit on a bunch of stuff, right? So one of the things is, not making any income 30, 60, 90 days, but sometimes what people are looking at in the franchise disclosure document is from when the store opens. But if it's a physical location, they have to take out a loan and pay their rent, pay back the loan, pay for all the equipment. And they're not even going to open sometimes 2, 3, 4 months while this construction's going on. And so a lot of times I see this big gap, right? Where they're like,
Mhm.
they have their projections, but they start on day one of opening. And so, well, what about all these other months beforehand? Um, what are other costs that people routinely underestimate?
I would say, again, depending on what type of franchise it is, if you have inventory, you mentioned up front, you're going to have to buy inventory ahead of time so you have something to sell. So sometimes that can be a significant number depending on how far out you have to buy that. And then the terms that your vendors are going to give you, a lot of times they won't give you much in the way of terms if you're a new business. So a lot of times you have to pay it up front. So now you need that money right now. So that's another thing similar to paying advanced rent. You usually have to pay 1 or 2 months in advance. Where's that cash going to come from? How much is it? So those are some key things there. Also, you have to hire employees way out ahead of starting work. You've got to train them. You got to make sure they get them up to speed. And oh, two of them didn't show up. They were here for a week and then they left. That happens all the time now. Well, now you've already paid them. Now you got to start over again. So you've got to plan to spend more money on hiring people, payroll, setting up benefits, inventory, rent, you name it. There's a lot of things. And again, the franchisors will go through a lot of that with you to understand what your capital requirements are going to be to start with. Then, as we mentioned, you build out a projection, a cash flow projection that will help you document from day one how much money do I need? Who's going to provide it? The owner as capital, or you're going to get it from a bank, or you get it from some personal friends and family investments. You have to look at all that stuff to understand how much money you're going to need on day one and all the way forward to the point where the business is actually generating positive cash flow on its own.
Yeah, that's really helpful. And I know you work with a lot of franchisees within the firm. From the experience of the ones that you have done, what is like item 7 usually miss? Is it or anything? Or usually the item 7's pretty accurate when you do your forecast?
I would say, I mean, we have enough with all of our 35 years of experience and my seasoned consultants. We are able to address majority of the things that could be something that's important to make sure is included. So with that, along with the franchisor documents, you're going to get information. So they're going to have samples of what they would see, what other franchisees, a typical franchisee might need. You're going to see those line items. So we then double check the two, kind of our list, excuse me, versus what the franchisor says. And we compare those two. So we make sure that we've accounted for as much as we possibly can. For example, legal. Are you factoring in legal? Are you factoring in bank fees? You're going to have interest expense on loans, utilities. We talked about rent, commercial insurance, insurance on the property, liability insurance on the business, workers' comp insurance for your employees. So you've got all these different factors, and we go through all those with our clients to help them understand what this is going to look like. For example, one big one is commercial insurance. Everybody thinks, well, it's going to be 12 grand a year. Great. I'll pay $1,000 a month and I'll factor that in. No, it's usually 50 to 80% down up front. So you're going to write a check for $8,000 to $10,000 on day one and then make several payments over the next few months. So you're going to pay for all your insurance over the first 3 to 4 months. And you're like, wait a minute, I can pay for this throughout the year. No, you pay it in advance. So there's a lot of expenses like that. If you don't understand how that works, suddenly your cash needs are a lot greater than what you thought.
Yeah, yeah. I think I mean, just that one note captures a lot of what people miss, right? Or what the assumptions that they have coming in that they get kind of hit with pretty quickly, right? And they've already signed the
Yep.
franchise agreement, so there's no backing out at that point. Um,
Correct.
okay, perfect. And then the other big part of getting going, you have these projections, is you need to get funding, right? Few people have or want to put four, 500, $600,000 out of pocket, especially they're like, well, I'd rather keep some of that in reserve, right? So I know that y'all have helped businesses with lending. Can you kind of talk about what you do there, what you look for, just the whole process?
Sure. Yeah, that's probably our biggest area that we really kind of partner with banks as well as accounting firms. But banks are our biggest source of referrals because bankers need good financial information both to get a deal done. They want to close on that franchise agreement. They want to close on that new business, that new customer, but they can't do anything without financials and projections. So the bankers know how important our information is that we provide and the service we provide. In addition to that, we have bankers, former bankers on staff. So we have former bankers that are also CPAs and accountants that have been through that process. They've been commercial lenders. They know exactly what's going to be required. And then we have our partners are bankers. And so we bring people in that know what we do and what we can provide for them. So we will partner with them to get the best possible package for our clients. So we will help them understand, okay, this is what your financials look like, your projections look like. And based on this, we think your total capital need is, let's say it's $2 million. You're going to need $2 million to cover the purchase of the franchise, setting up the business, all the upfront capital required to get the business off the ground. Where is that $2 million going to come from? Well, okay, I'll go to the bank. Well, the bank is not an investment. They're not an investor. They're a lender. So the banker is going to expect that the owner is going to put capital in. So they may say, we expect you to put 20% down. Let's say 20%, $400,000. The bank will lend you $1.6 million at 8%, let's say, over 10 years. So now the owner has to come up with $400,000 of capital. Do they have that themselves? If not, where is it going to come from? Are they going to get it from family and friends? Do they have a wealthy uncle? Who's going to provide the capital to make up the 400 grand? And it's got to be capital. They can't get another loan for the 400 and then borrow money for the 1.6. So that is the very first thing that we do to make sure where the rubber meets the road, the calculations work and the capital works and the financing works. Then we can take all this to banks and get 2 or 3 proposals from our banking partners that might be interested in providing the financing for this kind of a transaction. Oh, and then another thing, the other factor in there is that with the bank is going to charge a closing fee. So to do that $1.6 million loan, they may charge a $10,000 fee to complete the transaction. Well, did you factor that into your capital needs? Now you have an additional 10 grand coming out of what you expected. So it's those kind of things you have to address up front. So those are the things that happen before you get financing.
Yeah, and for the are there any special loan products or waivers of fees or anything like that that you've seen for veterans or service disabled veterans or anything like that?
We actually have a veteran on our team, and he handles those calls. He actually works with a lot of the programs in the country for veterans, so he can help make recommendations. So there's many different situation and variables. But yeah, there are opportunities for that. Even some of the banks that we work with provide that service. So depending on each of our prospects or clients, we can point them at folks that can probably help them there.
Okay, very cool. And then you mentioned the equity injection coming from friends and family or a rich uncle. Uh, is it, correct me if I'm wrong, but I thought that now the SBA is going to require anyone with any type of ownership to sign the personal guarantee, and now that's made it harder to raise money, or am I wrong in that?
No, there's, and again, I apologize. I don't have all the specifics in front of me on SBA, but that's definitely an option. But it is very, very stringent requirements now. And also, it's very expensive. So, although basically what's happening is the federal government is guaranteeing that part of that 20%, usually 10 to 15% of the 20. So that's why it's a good thing because the bank then only has to really guarantee, let's say 5% of that, not the full amount. So the SBA can be a good thing, but it's very expensive. So again, you have to factor that into your pricing and the cost to get it done. It has very strict requirements to get through the SBA, but you can go out to just the SBA on the website and just type in requirements and it gives you a whole list of those things.
Okay, got it. Um, and then so let's say I want to put together a package, or I want to know if I'm lendable. What are things that banks look for to know if they should lend to this person for a franchise or not?
Well, first of all, again, it'll be capital. What do we expect the capital to be? What's the total deal size? And then basically, okay, let's use my example of the $2 million project, 400,000 of capital and 1.6 of loans. Then what's going to happen is we run an amortization on that loan to understand what the payments would be. How much is the cash flow required to service that debt through the life of the loan? And that is very important because the business has got to be able to fund and pay that monthly loan payment, just like you pay your own car payment out of your home budget or your mortgage out of your home budget. You're now going to have to make this monthly payment for the business that you've signed up to get that $1.6 million. So we then put that into the projections to show this business can cash flow with that calculation and that expense on a monthly basis and make sure it all works. There's got to be enough revenue coming in to cover all the expenses of the business plus that debt service. That's what's called debt service, is making that monthly loan payment throughout the course of the loan. So if the business is seasonal at all and has some ups and downs, like a landscaping business, maybe they don't do much in the winter and they do everything in the summer. Well, you still have to make payments throughout the winter. So you have to come up with a plan and show that there's sufficient cash flow out of the business to make 12 payments, even though you're only open 6. So it's those kind of things that we build into the model, and we address those ahead of time because we know what the bank is going to ask. And we make sure that the model works before we ever present it to a banker.
Yeah, very cool. And then something that you brought up that I've kind of wondered about is if you're going to buy an existing business, there's a debt service coverage ratio, right? So for people listening, that they want to see that after you take over and you have this added debt service to the cash flow of the business, it equals some multiple, right? So maybe it's 1.5 usually or higher, right? So if your loan payment is $200,000 for that year, they want to know the business cash flow is at least $300,000, right? That's the
Correct.
1.5. So
Correct.
how do banks look at a debt service coverage ratio for a business that hasn't started yet? What are they looking at?
Well, they're going to look at comparables. So they're going to look at if there's other, for example, if there's other franchises in this same space, different parts of the country, or even in the same area, they'll look at comparables and come up with this is what we think it looks like. It seems reasonable. Lay that over kind of a template of this business to see if it makes sense and seems reasonable. What was the launch angle? How fast did it get to a point where it was could survive on its own? Does it take 12 months? Does it take 2 years? And then what happens in the world? Oh, we've got something like the Iran war. Does that impact this business? We didn't expect it. We didn't know it, but here's the reality. We got to deal with it. So you have to factor that in to understand that is this business going to be successful over the long haul based on our assumptions, and our assumptions reasonable to comparable business in the space. So that's what banks have access to a lot of industry information. They'll try to find similar businesses, similar industries, and they can get some comparables that they look at and look at those ratios for debt coverage and margins and revenue growth, those kind of things, to see if the information we're providing is reasonable. And the reality is we do all this ahead of time. We almost kind of pre-review it with the bank before we ever go through a formal process. So we kind of get the folks that are kind of friendly to us to look at deals and tell us what they see. And again, we've got bankers on staff, so they look at it, they know what to look for, and we'll get them to sign off on it first too.
Very cool. Yes, I mean, it's very helpful. And I think it's something that people need to think through, right? And they need to make sure it's in their models. Um, and that's why you need all three statements, right? So it goes to my next question is, um, you can be profitable. You could have a positive number on your bottom line of your P&L, but you could go out of business, right? You could run out of cash, right? So maybe could
Correct.
you explain that and how you help people prepare for that and business owners not do that?
Correct. Yeah. Like I said, cash flow is king. Cash flow is everything. And even businesses that are growing rapidly, successfully, and profitable can go out of business. Why? Because just because you're generating revenue doesn't mean you're getting paid. If you have a situation where you invoice a customer and they don't pay you for 90 days or 120 days, then you still have to run the business for that 3 to 4 months before that check ever comes in. And that's called accounts receivable. Now, every business doesn't have that, but most do. So we build that into our financial models to show you, based on what we know, this is what your cash flow model will look like. And here's where you're going to have a potential problem. In 3 months, 6 months, 2 years, whatever, based on the model, we can evaluate those potential exposures on cash flow. And then we talk about it. What are we going to do if that happens? Do we have some backup financing in place, like a line of credit, in the event we hit something like that? Make sure that stuff's addressed up front so you know the risks ahead of time and you don't fall into that trap without knowing it. So that's a big part of what we do.
Yeah. Yeah. Very cool. Um, and so now let's say that the business has started, right? They've done the projections. They're going through, um, the ramp. What are documents? What's data that franchise owners should be reviewing every week, maybe every month? Maybe there's something they should only review once a quarter. Kind of what are things that they're looking at?
Well, basically, right up front, you're looking at what's your revenue stream? Where are the dollars coming in? What are you selling? How is that money coming into your bank? And for example, restaurants, if you've got a franchise, we did a lot of work with Buffalo Wild Wings early in the days, and we would track sales by day, by week, and report on those sales weekly
Mm,
so that the owner and the general manager would know how are we trending by day for the week and for the month. How is our revenue tracking to what we budgeted? If we're supposed to do 10,000 a month in revenue, are we doing $2,500 a week, or are we only on track to do $500 a week? Do we have a problem? So you get on that right away, cash in. Then you look at the other side, you look at the expense side. What are the cash flow expenses going out? Payroll has to be paid typically weekly or biweekly. So you need to understand what's your budget, what those expenses should be, and what are your actual payroll dollars going out now compared to what you budgeted. Are they on track, off track, and what are you going to do about it? And you're always looking for those big ticket items first: cash in, cash out, payroll, and then revenue are the big ones. And then you're going to look at if you have inventory, what are my inventory costs? What am I having to buy? And a lot of times you have to buy it way ahead of time. We talked about that. So you may have to spend, let's say your only cost of goods going out is 25 grand a week, but you may have to spend 150,000 to buy inventory ahead of time to cover you for 4 to 6 weeks. So there's a cash flow issue that we have to address. The other thing, a big thing people miss is, for example, is sales tax. If you're in a business where you have to pay sales tax, your customers are paying you that tax, but you have to make sure you charge them the right tax, and you have to set that money aside and then be prepared to remit that money after the month end close. So that money must need to be set aside, and a lot of businesses forget that, and they end up using that money to pay other things because bills are coming due, and suddenly they don't have the cash to pay the sales tax. That's a big one for a lot of these companies, and so that's one of the things we work closely with our clients to make sure they understand that pulse of that flow and they do those calculations correctly.
yeah, a pretty big local bar here in Denver just got closed down and taken by the local government because they weren't paying sales tax.
Correct.
So I see that happening.
Yep.
Okay. And then what are some early warning signs, right? So that a business is drifting. And I think this will help kind of hammer home why it's so important to be on top of these financial statements.
Well, for example, again, we're going to build a budget ahead of time. We're going to be very conservative with that. So we're going to have a runway created for the business that says you're probably going to lose money for the first 6 months. And here's what that should look like. You're going to lose 10 grand a month for 6 months. So you're going to have lost $60,000 in the first 6 months, but then it should start to turn over after that. Well, we're going to monitor it by month. If in the first month you lose $20,000 instead of 10, we got a problem. Maybe we manage it for a month. What happens after the second month? Maybe in the second month it goes up, it's way better, and you make a profit in the second month. Well, now you're better, you're on track year to date. But we're going to track that every month. And if that gets out of whack and you continue to lose a lot more than what you said you were going to do and what we projected, what's wrong here? You're either not generating revenue as fast as you thought you would. So we need to know why. Can we fix it right now? What's going on? Second is your expenses may be way over what you projected. Why? What did you miss on? Because that has a big impact on your ability, what cash you have available to survive this first 6 months. So those are some basic examples that you got to be on top of. And if you're not tracking your financials, you may not know that. You're just looking at cash in and cash out in your bank statement. You may feel like, it's all fine, but you don't know until you do the financial statements. That's why
Yep.
it's so important to be on top of that.
Yeah, and a lot of businesses they won't catch it until their bank account's going down, where they would have seen that they're making a little bit less every month, and they could have stopped it 3 months ago, right?
Correct.
Um, and so, especially in seasonal businesses, that are like
Correct.
mildly seasonal, right? Because like if it's super seasonal, they're like they expect it. If it's just like mildly, then that's where it kind of catches them, where they should have reduced payroll or they should have reduced hours or something.
Mhm.
Um, yeah, and so that having these projections and kind of being able having someone who's seen probably hundreds of businesses the way that you guys have, you'll be able to know, hey, no, I actually know that this type of business always in the wintertime, people are spending money somewhere else, right? Or whatever it is.
Right. So I got two real quick examples I can use that talk about that seasonality and fixing cash flow, because both of these are still clients of mine. I've had them, both of them, for over 20 years. They're longtime clients of ours. One was a golf course in my hometown in the Twin Cities, and they opened as quickly as they could in the spring.
Yeah.
As soon as the snow's off the ground, they try to open up. So they would open up, let's say, April 1st. And they are open through, let's say, October 30th, October 31st, November 15th, somewhere in there. And then they're closed. And they're closed for 5 to 6 months. Zero revenue coming in. They've let their people go because they don't need them around. They still have expenses, though, during that period. They still have debt service. How are they managing cash? So the money they bring in during the season, they generate a lot of revenue, a lot of profits, and then it all stops for 5 months. How do you manage that? So we help the client figure out, doing that cash flow model, to help them understand we need to have enough reserves in cash by the time we close the business to survive 5 months without tapping into the line of credit. And that took us several years to get them on track. But now, even after it's been 15 years and they've been cash flow positive for the whole time because of what we've helped them accomplish. Second, as an example, is a 80-year-old jewelry store. I've been in the Twin Cities for 80 years.
Wow.
Think about this. At the time, their really only revenue came in at Christmas, November and December, buying Christmas presents. So the rest of the year, they lost money, January through October. Can you
What?
imagine that? Talk about seasonal. And then you're counting on that you're going to generate enough revenue to be a profitable business in those last 2 months.
Wow.
But they had been around for 80 years. So we had to go in there and change how they manage cash and made it more predictable business and anticipated changes up or down. And again, they've been a client for 25 years.
Wow. Um, they don't, I mean, maybe this is getting off topic here, but like, do you guys help them with the model? I feel like if you have a golf course, you could be running events during the wintertime. You could be doing, there's got to be other things that you could do with that giant piece of land and your nice gazebos and whatever, right? And I don't know. It just seems like there's got to be other stuff. I don't know if you guys do that or you send them to other
Oh, yeah,
people.
we definitely do. And we've helped certain clients do that. It just depends. In certain situations, it's not they don't have the fancy space to do something like that. But yeah, theoretically, you could do other things. And we've helped them. Some of our clients do stuff like that. In one case, we had them move outside of expensive space and into less, 25% of the costs they were paying before to get their fixed costs down. So yeah, we look at all those kinds of things.
Mhm.
It just depends on each situation and what their unique needs are.
Yeah, so it's very holistic. That's cool. Okay, let's talk now. You mentioned the different services: bookkeepers, CPAs, controllers, fractional CFOs. Like, what's the difference between all those things, and at what point do businesses need to step up to each one of those
Okay.
functions?
So every business, in my opinion, needs a tax CPA, a CPA to do their taxes. That's not us. We can get really close, but we're going to bring in a CPA firm to do your taxes. But in our opinion, we stay in our lane and we let them stay in their lane. So we focus on the client side, the internal books, internal financial statements, and then we hand off the year-end product to the CPA to do the tax returns.
Mhm.
That's how we do it. So that's why you need a CPA and someone like us. So when you're doing your accounting, frankly, as soon as you start business, you need somebody that knows what the hell is going on to do your bookkeeping and your financial statements. Even if you're small, You need to get started with something. You don't want to wait too long, because it just becomes to be a bigger mess to clean up later. We always have to go back to inception to start. So you might as well start right away than waiting a year or two before you do this, because then you may be too far gone. And we've seen situations like that. So now a lot of times you don't need more than a bookkeeper, basic bookkeeper that understands core accounting software and get basic processes set up. And that doesn't have to be extensive. We have a lot of clients like that, but there is a cost to have the basics done. It's got to be factored into your budget. And then as you grow, your needs will get bigger. As the business gets bigger, it's more complex. The accounting is more complex. The reporting is more complex. Then you need more senior help. That's where you might get staff accountant or controller to oversee the financial close of the business or oversee the people that are doing the books. You want to avoid having one person doing everything, because if that person leaves, who's going to replace it? That one person's gone. You need backup. So in our model, we always create teams. We always have 2 people on every account to make sure there's some oversight and backup for our clients. There's always at least 2 people that know what's going on with that client and can step in if needed. That's a big deal in our model. Then as you get bigger, at some point you may need fractional CFO help. If you're getting bigger, let's say you're 2, 3, 4, 5 million in revenue, 10 million, 20 million in revenue, that's when you may need a CFO. They can oversee everything from HR, from financials, the accounting, internal controls, financing, bank relationships. That's what a CFO does.
Gotcha. Okay. Yeah, I think that's super helpful. So, to start off, everyone should find a bookkeeper, basically. And that's been, we took us like a month to find a bookkeeper when we got started. Who anyway, and it was just they were already like, what is happening with these? And I was like, oh my God, I'm so glad it was only 1 month. We didn't wait, 3 months or 6 months or a year. Then obviously the CPA, like, you don't want to be doing your own taxes. It's so easy to mess them up, especially as a business. It's not like personal taxes.
Correct.
Do you all help with tax strategy, or is that something you talk to the CPA with who's doing your taxes as well?
We usually kind of tee it up and we know some of the key issues and we'll bring
Yeah.
those forward. And then we usually always have a conversation. We always say with the stakeholders. So we'll bring the banker in, we'll bring in their tax accountant, maybe their attorney, and then us along with the client. And we'll have a powwow and talk about all the issues affecting the business. So all stakeholders have a chance to contribute information about this to understand what's going on.
Cool. Cool. Okay. And then let's say they have a bookkeeper, right? And that's about it. And they want to sell. Maybe they've gotten to, $1 million, $2 million. What does it take financially to get ready to sell? Usually if you have a bookkeeper and you're using QuickBooks or whatever, right? What does it take to be ready for an exit?
And we do a lot of that with our clients. We helped a lot of our clients sell their businesses. The key thing is clean financial statements, because any potential buyer is going to want to really go through your financial statements with a fine-tooth comb. They're going to want to understand all the numbers and make sure they make sense and that they're accurate and that they believe them. Depending if it's depending on the size, they may require an audit or what's called a Q of E. And that's where an outside CPA firm actually does a basic audit of the financial statements to make sure they're accurate.
Mhm.
So in order to do that, you better have your books in order and your financial statements right. And what's usually required is 2 to 3 years of historical financial statements by month, that they're accurate and tie back to tax returns and things like that. That's a huge deal. So you better have that right when you're going to start to look to sell. And then on top of that, we build a projection model that they want to usually see 3 to 5 years of projections. So you have 2 to 3 historical years that are actuals by month and 2 to 3 years of projected financials, typically at least 2 by month, and then annuals after that. And what they're trying to come up with is, what is the revenue growth of this business? What are the margins like? Are the margins improving or decreasing? What are the large expenses of this business? And then what's the profitability of this business? And then what's called EBITDA. And that's a little more complex term, but it's a calculation off of your profit. And that's what's usually used to then multiply that times an industry standard, which may be 3 to 5 to 7 to 10 times EBITDA to get what's the value of the business. And every industry is different. So there's a lot of work that goes into that. But we do all that kind of work for our clients. And then we can help meet with the potential buyer or a potential broker that's going to help sell the business. We can do that to lay it all out so that that information is ready to be consumed by either the buyer or the buyer's representative to help sell the business. That's really important. So if you don't have good financials, you're not going to be able to sell it.
Yep. And I think helping with those projections, especially if someone owns a growing business, you can get more for it if you can say, look, an outside company made these financials and said we're going to grow by X percentage, right? So it's super important to have someone outside to do it and build those projections, because that can help you, make more money on the exit.
Absolutely. And the other, one of the nice things too is that if we come in to do a project for a client like that and we build that all out, those costs can be what's called an add back, meaning that those costs can be added back to your EBITDA number. So you don't get dinged for the expense of using us for that, because that may or may not be a regular occurrence for you. So we can add it back to say it's not a normal operating expense. So it just depends on what kind of work we're doing.
Awesome. Awesome. And then we're coming up close to time here. But I do want to hit a couple things. One is financial advice for someone who doesn't want to start from scratch, right? They want to buy an existing franchise. That's a whole, you could speak, I'm sure, for hours about all the stuff you need to think about. But if you give us like a 2-minute kind of top highlights of what people should be thinking about when they're looking at buying existing franchises.
Well, it's just the opposite of what I just said. It really is that you're going to expect, you want to see at least 2 to 3 years of historical financials. If I'm buying a business, how do I know it's performed? How did it do the past few years? Is it profitable? Is it growing? How do I know that's accurate? Are the revenues accurate? Have they inflated those numbers? How do we know it's right? Are they fubbing the numbers? Are the expenses accurate? Does it seem reasonable? All those kind of things, you're looking at it to say, does this make sense? And you're going to get people to help you look at that. That's what we can do. We can help evaluate those financials. And is it generating a profit? Is it profitable enough? Does it make sense? Based on that, how much is going to be come off of that business to pay you? If you're going to go work for the company, is there money in there for salary for you? Is it already built in there with the former owner's comp in there? How much did he make? What if he only made 25 grand a year? What if you're used to making 200,000 a year? When you lay that into the business, it doesn't work. Well,
Yeah.
that's going to be a problem. So you're going to look at the historical financials, understand how that looks, and then look at the projections. How is this business going to run the next 2 to 3 years? This is what it was doing. If I can do the same or better, how do we make it better? And does this seem reasonable to accomplish? And does that get you to a place where it makes sense for you to put money into it, to buy it? So those are the things we help, and we are independent. We're not one of your employees. We're going to be direct with you to help you understand, does this make sense or not? Or at least here are some of the concerns, potential landmines you better look into. And then you bring in other outside parties to help evaluate those things as you look at it.
So you guys do quality of earnings reports?
No, we don't do quality of earnings, but we can do the prep work to take it there. So
Got
we
it.
can do all the work to make that piece easier, but we're not going to do a QOV. You have to have the, an authorized CPA to do it, and you're just doing that because they're issuing an opinion on a report, and that's not what we do.
Got it. Got it. Okay. And then, a lot of these franchises I see for sale, are smaller, right? So maybe half a million to $1 million in revenue, doing maybe 100 to 200 grand in profit. Um, do you see these and you often say, show, hey, yep, these are good numbers, or do you often see those and you're like, hey, this is a really messy business? What should people be prepared for if they want to start thinking about these types of acquisitions?
I think it's really understanding how complex is this business and how much work is going to take to maintain it. Is it super labor intensive? Is it going to require the owner to have all his time into it every day? Or is it pretty much a vanilla flip? It's just an easy thing to do, can be done remotely. You don't need to have office space or retail space. Depends on the business. So you have to evaluate those things and really understand and think about how hard is it going to be to run this business. And so you really get into those details and then kind of tie that back to the financials to understand. For example, if you're going to open a restaurant, There's a lot of work, and you need to know what you're doing to open a restaurant. Just because you have the money to do it doesn't mean you know how to operate a restaurant.
Yep.
Money starts running out of that business on day one. You better understand how to do that. That's why not many people want to get into that unless they really understand it. It
Mm,
sounds flashy, it sounds really cool, but it's a lot of work. So you better be good at it and be willing to put a lot of time into it to make it happen. So it just depends on the business.
cool. Okay. And then, so as we wrap up here, what are what's some advice that we haven't covered that for people who are thinking about buying a business that they should take away from this?
Biggest thing is, I would say, is really get to know the business model and understand as much as you can about what you'd be getting into and what's the nature of that business within the industry it's in compared to the current economy. And what do you see happening in the world 5 to 10 years down the road relative to this business? Make sure you understand the macro situation for this business. And then, as we talked about, understand what the investment would be. Do you even have that kind of money? Are you willing to invest those kind of dollars? And are you willing to commit the time and effort and maybe not make any money for a long time to get this off the ground? Make sure you've got the commitment to do it. And then as you do that, build out some models, get some help and build out some samples so you understand what this can really do. And then lastly, take it to some bankers and just say, find somebody, either us or other people, that can bring these to a banker to say, tell me what I don't know. Let's talk through these and maybe get some banks to give us some feedback. We have good relationships with bankers that'll just independently review it with you and give you their thoughts. That's a great way to understand what things am I not thinking about from a banker's perspective and do that out ahead of any effort to actually buy something. That would be my suggestion. Oh, and
Awesome.
finally, besides making sure you got sufficient cash, make sure you're passionate and you love this and you want to do it. You got to want to do it is the very first thing. Second is have enough cash.
Yeah. Yep. So I think you hit two huge ones, right? Don't go into this if you're gonna run out of money, right? Know that you're gonna be a worse operator than whoever's running it. So it's gonna get a little bit worse before it gets better. Um, and it's really hard. It's way harder than people think. There's I think AJ Wasserstein from Yale has written a couple of good articles about, should you be an entrepreneur, top 10 reasons not to be an entrepreneur, um, how it affects your spouse, right? Like those are all things that you should consider. You should go and read. Because the last thing you want to do is invest $500,000, have another $1 million personal guarantee, and you realize you don't like doing it. That'd be
Yeah,
terrible. So,
that'd be terrible.
yeah, all
Yep.
really good advice. Thank you so
Yep.
much for being here, Daryl. Again, I'm Josh with Tracer Franchising. If you want help looking and finding great franchises and doing the research, visit tracerfranchising.com. If you need financial help from Daryl, you can go to tmgconsulting.biz, and that link will be in the show notes as well. Okay. Thanks, everybody. Daryl, thank you.
Thank you.